it seemed like late last year, and what we were talking about already was the fact that Huawei was already, in some ways, really beating out the competition in China when it came to the iPhone and Apple. Do you see any kind of change in that trajectory now that we're talking about two new product launches coming through?
I think that lead will only widen. Q2 2024 was the quarter that Apple fell out of the top 5 in the Chinese smartphone market. And remember, that's not just China. That's the rest of the world where China is dominating hardware. South Asia, Southeast Asia, Middle East, Africa, and Huawei is there alongside of Oppo, Vivo, Xiaomi, and there's no Apple equivalent in those markets. And this threefold phone out of Huawei really is specifically designed for meeting these consumer demands, which are different than those of kind of mature markets. So consumers that like to use a tablet for all of their work purposes. So I think that lead is going to widen, and Huawei is designing American components out of their value chain anyway. So it's all bad news.
Ben, let me pick up on that very last point you just brought up. David here, by the way. With this, we've been talking about this competition between the two with you for several times now. Are you starting to see the supply chains align more on respective sides? What progress have we seen on that?
Well, obviously, for decades, the Chinese were dependent on American chips or Taiwanese chips, and of course, ASML's equipment for producing chips, and so a lot of their supply chain was outside of China. With the effectiveness of those early bans, the 301 bans and entities list bans that hit Huawei and ZTE, China went into overdrive to build their own chips and design out foreign components, and we're now seeing the fruition of those labors. It's not certainly time to declare victory, but this new Huawei Mate XT will have a Kirin 9 chip. They have an Ascend 910C chip, which looks to compete with the NVIDIA H100. And so it's clear that they are moving at light speed and beating any kind of preconceived notions of the timeline it would take them to catch up in designing out foreign components.
Is there anything that you're looking out for in this chip that could be on this Huawei phone? I mean, could it spark a little bit more of that China rhetoric in the U.S. to maybe implement more sanctions on the company? Do you think these sanctions are going to be enough to actually stymie that sort of growth?
I think actually it might cause a reversal and a review of those sanctions to understand that those sanctions have done nothing but improve Chinese and accelerate Chinese self-sufficiency at the expense of American chip producers, for many of whom China was 30 to 40% of their market and of their overall revenue. And that's lost revenue now that was going to go to R&D and aid in maintaining America's chip advantage. And so I think actually it would cause a review. We've already, as America, got our allies in Japan and Taiwan and Korea and the Netherlands aligned to prevent some of the highest end chips from reaching the Chinese. And even in the face of that, the lowest nanometer chips are already being produced locally, still not at the highest tiers that NVIDIA or TSMC can produce, but very much sufficient for consumer hardware. And so I think this should cause a review and the effectiveness of sanctions in slowing China's growth.
Yeah, well, Ben, on top of geopolitics, and you mentioned slowing Chinese growth, if we could just pivot really to the underlying economics and what's going on with the business environment there, how are you guys doing? How are you and your VC peers doing? How are tech entrepreneurs doing? What's sentiment like right now?
It's a very challenging time. We're calling it kind of the lay flat generation. Valuations of private companies have been flattened down, as they have been across the world, particularly in the venture space. Public markets have obviously been decimated, notably in Hong Kong, but of course even the big names, the Pinduoduos and others that are listed in New York on solid fundamentals and slightly bearish news are being punished 20-30% on Q2 earnings. And so it's a really challenging time in geopolitics. Obviously overlay it. That's prevented a lot of capital from coming to the Chinese market. But in spite of it, there's still signs of growth. Anything in the core technology space or sectors that are really within the regulatory slipstream of the Chinese government are still getting plenty of RMB funding. And so the robotics space, space tech, operating systems, core technology, quantum chips are seeing robust funding from government sources. And of course, anything built in China for the world, be it EVs, solar panels, cross-border e-commerce, all thriving. So there's plenty of good news, but it's overall set against a very depressed landscape.
Yeah, you certainly kind of painted that, Ben. I'm just wondering, what does it do for a VC fund like yourself? I mean, does it force you to look overseas now and other opportunities?
So we had seen the writing on the wall several years ago. We started and have been investing across the world, and we are a global firm and had been investing in North America, in emerging markets, particularly in the Middle East, dating back to 2015, 2016, and set up other franchises in 2018, 2019 in those markets as well, and set siloed funds. And so I think those that were listening and reading the tea leaves understood that there would be geopolitical challenges, and that also China was just going to get a lot harder. A lot of that, low-hanging fruit had been picked. A lot of the new sectors that were emerging required a lot longer time to monetization, a lot more government regulation, and certainly higher technical barriers to entry. And so we certainly expanded with that in mind now, 5-6 years ago, and that has certainly done well for us. But we've maintained investing where we believe there are pockets of opportunity in China, and those have continued to grow. We had a company called Black Sesame go public a few months ago, just a few weeks ago in Hong Kong. It's trending upward. So certainly there are still companies that are doing well, and as long as we stay within that regulatory slipstream.
Yeah, Ben, tell us more about some of whether these are new emerging trends within tech itself that you're starting to notice and might maybe pull the trigger on at some point, or some of the changes that you've noticed. You've lived in China, and how consumers are spending their money, changes in consumer patterns, for example.
Sure. Consumer has changed significantly, obviously because of the downturn in real estate valuations, which hits people's kind of personal net worth, and also, of course, the stock market declines, which had the knock-on effect of creating more job scarcity, lower salaries, even returned bonuses. Chinese consumers are very hesitant to spend. We now have about $12 trillion of household savings that's pent up like a dam, hopefully ready to burst, compared to only about $900 billion in the United States. But what that means is that people aren't spending on big ticket items. They're certainly not spending on real estate that kind of created that flywheel that was driving a lot of China's economic growth. But they are still consuming, and it's kind of a consumption downgrade cycle. Rather than spending on homes and large ticket, they're spending on events, concerts, going to football matches, which are sold out in China. They're buying domestic brands, so we've invested heavily in domestically built consumer brands, so cosmetics, fashion labels, QSR, so quick service restaurants that are built domestically and scaling very rapidly, that are at low price points. All of those are doing very well.
Yeah.
They're also sticking domestically to travel, so domestic travel.